And there we are. Right. Okay. Sorry, it always takes a few seconds for the platform to pick up all the different platforms we're streaming on. Hello, everybody. Welcome to another mortgage market live stream video with Graham Taylor from Hudson Rose, Lewis Shaw from Shaw Financial Services,
Hello.
Both of whom run their own independent whole of market mortgage broking services, both of whom have been providing you guys who've come through my website to talk to brokers for getting on for a couple of years now, actually. It's 18 months, certainly. Yeah. And today we are here. I will be doing a lot less talking. I will be giving both Graham and Lewis as much opportunity to talk about what they want to talk about as possible, and of course to take your questions. And we do have a few questions, but I would like to, so welcome Graham, welcome Lewis, thanks for coming again. I would like to start because I think Lewis has something he wants to talk about on the concept of decisions in principle, or mortgages in principle, or agreements in principle, and what actually is a real one and what isn't a real one, and why it's important to movers to know this. So Lewis, what do mortgage borrowers or potential mortgage borrowers need to understand about the whole in principle thing?
Sure. So the big thing is that you have to be careful. If you're going to do them yourself online, you have to be aware that they may not be as accurate as you would hope them to be, is the first point. So when I'm talking about this, I'm talking about doing it direct with a lender, not a brokerage. I'm talking direct to a lender. So if you want, if you bank with Bank X and decide to go do a decision in principle with them, is to be aware that they may not be as accurate as you would hope.
The online ones, you mean?
Yeah, the online, yeah. So, right. So for example, I bank, my personal bank is Lloyds. I bank with Lloyds Bank. So if I went online and decided to do a decision in principle myself with Lloyds Bank online, now being a broker, I would know, because it's broadly the same as Halifax, I would know what income to put in what boxes. But nevertheless, it probably won't be as accurate as doing it direct through an intermediary system. For the simple reason that if you imagine the online systems that banks and building societies have direct, they're not going to be going into as much detail often as we are. Or, for example, if you decided to go direct to a bank, as you would go through when you spoke to one of their employed advisors, simply because they need to be designed and built so that anyone can use them. So as a consequence, they tend not to be as accurate as you would like. Now, that's not always the case. So if you're a single person and you have just a base salary of X, you don't receive any additional income or any commissions or that kind of stuff, and you've got a solid deposit, no debts, no children, so extremely vanilla in that respect, where there is nothing, then yeah, it would be pretty much bang on the money, I would think. But the reality is that most people aren't in that position, or at least a lot of the people that I speak to, probably the same with Graham, and most mortgage brokers around the country aren't in that position. And so I've had a few instances recently where people have obtained decisions in principle online often with the banks that they bank with, because it's easy to do. You can usually do it through an app, etc. And most people, understandably, think that that's kind of cast in stone. At least that's the way it appears to them.
So what you're saying is that it could be more. When you say it's not very accurate, you mean the borrower might be missing out on a different amount or a different rate, or both, or
it could be all of those. It could be all of those. So I mean, there was this has changed now, but there was a bank where people thought they were getting a decision in principle, but realistically it was just an affordability calculator. There was no real credit check carried out, etc. But yeah, it could be that they could borrow more. It may be often it's that they can't borrow quite as much. Mm-hmm. But the problem lies there in that, understandably, again, because it's it'll be a well-known and trusted institution if you've got a current account with them. And of course, people then go off and start making offers expecting that to be fine, and then it turns out that it's not, because actually when you get down to the nitty gritty of it, and you start putting the numbers in the right boxes, etc. Because of course you've got to imagine an intermediary system is much more detailed in that than there will be on just an online system.
Okay. So to summarize that, your message is go through an independent broker with the full intermediary system, and you're much likely to find, if not a better amount, then also or better terms than you will from a single lender's online AIP.
I mean, partly, but more so in terms of when you're looking at making an offer on a home, if it's the place you found, you viewed it a couple of times, you negotiated the price, you're emotionally invested into it, and the last thing you want is to that then fall down at essentially the first hurdle, which is then the application. So it's that. So as I say, so for example, recently I had a young chap in the last 2 weeks where he got 2 decisions in principle online, then went direct to that particular with one of the banks, was declined due to affordability, came to see me, and so he'd already instructed solicitors. The house had been tied up by the estate agent. The people that they were selling had offered on another property, and within the first 5 minutes I had to say, I'm really sorry, but you're not going to get that borrowing. This is just not going to happen. So let me tell you what you can afford and what you can buy up to, and then here we go. So it's, and of course his heart was set on that, understandably.
Yeah.
But not just that. There were people that had started work, so solicitors had opened the case. They were about to start the searches. The person that was selling was just waiting for an offer so that they could then complete a chain, which then, of course, all fell down. So it's not to say that you shouldn't. Of course, if people want to go direct to the banks, of course they can. That's, I'm not here to say that at all. But it's just to be aware that they often aren't as accurate, and that can lead to, some heartache in the future, and it can also lead to a loss of money, because if you pay the search and you think everything's fine, or all that kind of jazz, or some people jump the gun sometimes on surveys, etc. So it's just to be aware of that. And I don't want to labour this point too much, but there are specific brokerages that offer online agreements in principle where you don't talk to anyone, and they are extremely inaccurate. So unless you've spoken to someone, whether that be
extremely accurate, did you say? Inaccurate. Sorry, I thought you said extremely accurate.
So unless you've spoken to someone and given them your details, whether that be a broker or whether that be your own bank or billing society, unless you spoke to someone, given them your details, all the rest of it, then please just not treat it with a pinch of salt, because for some people it will be accurate, but with an air of skepticism, I suppose.
Yeah, understood. I think that's a really valuable point for everyone. Is there anything you want to add to that, Graham?
No, not really. I mean, Lewis has hit the nail on the head herself. The bit I'm not aware of the larger firms that do a in principle decision without talking to anyone, but there are firms out there that will issue their own mortgage in principle certificate, one of which even claims it's invented a new thing. It's saying a mortgage in principle, a decision in principle, an agreement in principle. It's always been the same in my world. They're just different terms. But yeah, where you have something that hasn't come from a lender, so it hasn't got that the lender name, or you don't know who it's from, it's just from a broker saying we think you can borrow that much. That's where you've got to sort of urge a bit of caution, or exercise a bit of caution, I say, because if there's no credit check be placed, and all they've done is basically an enhanced affordability calculation, which is obviously a starting point for any broker, but it's that second bit of getting credit check that gives you a bit more surety. And as Lewis says, using an intermediary, or indeed using a bank direct. I mean, let's not forget, if you really want to cut a broker out and you want to go to a bank, then having a conversation and get them to do their decision in principle will at least give you surety that you've got something that's credit checked and is suitable if you're going to go and make an offer on a house. Of course, what you lose with going to a bank direct is that you don't get that that whole of market search. You've got no idea about whether or not the product's right, whether something better, whether you could have got more or less, all the other stuff. But yeah, certainly if it's just something coming from an intermediary with their logo at the top saying, thanks for your call, we think you can borrow this is our mortgage in principle, I'd be a bit cautious, because you could come unstuck pretty quickly.
Right, we've got lots of questions that were sent in advance of this. And for everyone who's watching live, if you've got questions, put them in the live chat. But I am going to prioritize the questions that came in ahead of time. And thank you to those of you who put them in. We've got someone on YouTube, MONC2206, who asks, I will be using Charlie's offer template. do I need a revised AIP every time I offer on a property, or just one AIP stating the max amount I can borrow?
Okay, I can answer that one if you want. There is no right or wrong answer. It does depend. Your AIP isn't property dependent. So when you get your mortgage, your agreement in principle, your mortgage in principle, whatever you want to call it, okay, then that is looking at your income, your outgoings, your general situation, coupled with your credit score to give that decision. What it doesn't do, because it always comes before you found a property in most cases, what it doesn't do is take into account any property type. So you could have a decision in principle with, insert lender name here, and then you go out and want to buy something that's completely unmortgageable. Well, they're not going to lend on it because that property is the next stage. So as long as your decision in principle certificate is in date and covers the amount that you'd want to borrow to buy that house, then no, you certainly don't need to change it. The only time you'd want to have a check, and again, what we advise to our clients is say to us, look, here's your decision in principle, you're going out looking, keep us updated, perhaps just give us a ring when you found the property before you offer, just so we can sense check the property type and we can look at think, well, do we actually need to speak to a surveyor, or is there another lender, or is this going to be some problematic thing here? So no, they're all fine. And what I would say is that even if we've had it recently, because it's taken a long time to find property, always does. Sometimes the certificates expire, and it might be a couple of days, and it might be sort of, I'm going to look at property tomorrow, but my decision in principle certificate expired today. Is that a problem? No, 99% of agents are fine because you proved the point, right? Unless you've had an awful 3 months or month where you've defaulted on all your bills, right? Then generally they'll be okay. So don't panic if you can't get updated for that point. You can make your offer, show them you already have one that was valid until yesterday, day before, and that you're working on getting the new one. And again, broker services, what we do is we say to clients, give the agent our number. They can ring us up and we will explain to them without releasing any personal information that everything is fine, this is what's going on, and that often smooths over the offer and adds weight ultimately to the offer that they make.
Fantastic. Okay, thanks. Right, next question is from Leslie Smith 8014 on YouTube, who says, can you guys confirm a recent report that mortgages are being restricted with respect to a house with an EPC categories D or lower, D, E, F or G?
No. Well, I certainly haven't seen that. I recently did a mortgage for a property that was an F. D and E are very common, especially in older buildings, especially in, for example, in Graham's area. I suspect that's the case because they're very old stone buildings.
Well, they're exempt, a lot of the listed buildings around because listed buildings are exempt anyway. So yes.
So no, I've not seen that. I mean, certainly if it was you're buying to rent it out, then the EPC can factor in. And certainly if you've got an A or B, often EPC rating, you may get a preferential product with a lender if it's more energy efficient, but I've certainly not seen any mortgage being restricted now.
Okay. We've now got, this is have either of you guys seen the clip from Honest Money, Darren Deegan, where he talked about being shocked by how much his lender was offering him when he applied for a mortgage with his also self-employed wife? Let me play you this clip. I play everyone this clip so they understand the context of it. He's a YouTuber with many more followers than I've got, 3 times more followers than I've got. And he talks about money, not just house prices and mortgages. But I think it's worth listening, just hearing this 60-second or so clip, and then just discussing what he said, because I've had a lot of people asking this question. So one moment while I get it. It's just about 60 seconds. Sorry, guys, let me get it up on the screen.
So they asked me how much I'd want, and I said, right, I want X amount. Thought that should be well within the reasonable request. And sure enough, they come back and said, yeah, we can give you that. It's absolutely fine. And then I said to them, just out of interest, what's the maximum you'll lend me? And the guy said, well, technically, we don't really tender you the maximum. You have to ask for an amount, and then we either approve it or disapprove it. And then I spoke to him for a little bit longer, and then he just told me straight out. He told me how much I could borrow. And I was shocked because I've made videos on this over the past year, how affordability should impact the amount of money that people can borrow. But they offered me more last week than what they offered me at the peak 2 years ago. And actually at the peak 2 years ago, I I was actually earning a bit more than I am now because I was doing a bit more work, whereas now I don't really push as hard, so I'm not actually earning as much. So I said to him, how come you're offering me that much? And he said, well, our standard multiplier is 4.75% joint income, which in this market, I was shocked because even a year or two ago, getting 4 or 4.5 was kind of the norm. And when you consider the inflation that we've seen and you consider the interest rates have gone up so much, the fact they're now offering 4.75 affordability, and this is for people that are self-employed, and this is from a big provider as well. This was from First Direct, and the reason I called them is they were market leading.
So this is the question. So he meant 4.7 times, not percent, 4.75 times joint income. And the question, so this is Odysseus on X, who said, ask your thoughts on if it's a moral hazard occurring where lenders are actually starting to increase what they're offering. I mean, I don't know what to say to what Darren has just said about that, but I mean, he's genuinely surprised. And I wondered if you guys had an opinion on that.
Well, I think the first thing is that 2 years ago, we were coming out of COVID. And what we saw when COVID was businesses getting decimated and not being able to trade in the way they would. So lenders did restrict lending to, if I'm correct, let's correct me wrong, but it's self-employed individuals. There were multiple caps that came in for the self-employed because there was a bit of risk of how is this going to come back. So I think if it was 2 years ago, all this happens is gone back to normal because, bar a few exceptions, it doesn't really make a lot of difference whether you're employed or whether you're self-employed. Lenders, how they calculate their affordability is down to them and their risk teams at the end of the day. But I think it's probably one of where we were as a country and where businesses were following the pandemic rather than any outlook on whatever other metrics they were looking at. That'd be my take of it. But Lewis may disagree completely.
I think broadly, yeah, I'm on board with that 100%. So I think one thing to understand about income multiples is that they're set as a cap in the background. They're not the be all and end all. There's far more that goes into that when it comes to affordability. So it's not just salary times X. Which all they're looking at your overall indebtedness, the term of the loan, your household makeup if you're a single person or if you've got a family, etc. If you've got children, how many? Are there any costs associated with that? There are a lot of metrics that play into that. So the income multiples that sit in the background, if you are, as I mentioned at the start, if you're a single person with a high income, no debts, no dependents, and a healthy deposit, then yes, they're going to potentially be able to potentially stretch affordability. That said, the income multiple doesn't always necessarily mean that you'll get it. It's just a cap in the background. And of course, I mean, there are income multiples higher than 4.75 times. There are specific lenders that will go up to 5, 5.5, and in some cases, even 6 now. I think that's a bad idea personally, but it does exist.
Okay, guys, thank you very much. We've now got another question from Elite Alex 000 on YouTube, who says, and the question's there, what percentage of your take-home salary would you suggest is sensible to pay in mortgage fees? The banks will lend us much more than we deem sensible.
So as a percentage, so how much is it as a mortgage payment as a percentage of your take-home pay?
Yes.
I mean, it's very, very difficult to answer that question because, again, it depends upon your lifestyle. It depends where you live. It depends what your current outgoings are. Because what you may deem far more than you can afford for someone that has very little outgoings and lives like a Trappist monk, then that might be fine. As a rule of thumb, when I can remember working when I first started in mortgage, my second job in mortgages, working through an estate agency group, and we had a rule of thumb where you would look at their future commitments, what they were going to be, the household expenses, the food, the fuel, any credit commitments, etc., childcare costs, and we would net that away from their total household income, and then we would take as a maximum 75% of that as an absolute maximum. So that was a proxy that we used. So even if a lender may advance more than that, we, from a compliance perspective, wouldn't exceed that. So 75% of your pay after your household running costs as a maximum.
Okay, I'd like to take this opportunity quickly to just say to anyone watching who hasn't yet spoken to an independent mortgage broker and would like to talk to either of these guys, either Graham's team, he's got 3 offices in Gloucestershire. Lewis, you more of a virtual guy, but you cover the whole country, don't you? I mean, you both cover the whole country.
We both cover the country.
mhwc.co.uk, that link there, which is also in the description below, mhwc.co.uk/mortgage, if you'd like to talk to them. Right, next question, also from X, is from Duncan Cowan, who says, regarding a mortgage in principle, if an offer is accepted, does the lender redo the whole thing with the latest income, or do they use info from the MIP? If the latter, does that remain the case throughout the whole buying process, or if it expires, must it be redone?
So the so the mortgage in principle, if it's valid and you're going back to the same lender, forms the first part of the application. So it's the credit check. But you've still got, but to get your agreement in principle, you haven't actually submitted any documents. So if you had a situation whereby you did an agreement in principle based on, we did affordability for someone that was maybe earning overtime or commission or whatever it was, and we used maybe 3 months or 6 months pay slips to demonstrate and get that agreement in principle that was affordable at the time. If they then came back to us 8 weeks later, the mortgage in principle would still be valid, but there is a chance that actually the documentation, because if they hadn't earned as much overtime in that intervening period, might mean that when it got to underwriting stage, the pay slips or the documents you're going to present to the underwriter aren't going to stack up to meet the affordability that was run 8 weeks before. So if everything stays the same, then they will run, they'll certainly use the credit score data that was done for the agreement of principle. That's fine. But obviously the agreement of principle is just giving information about your situation to run a credit check. So it's the next bit when it gets to documents and underwriting that everything needs to stack up. So if things have changed and that agreement of principle wouldn't then be valid, it's going to get caught, it's going to get looked at, and it's going to come back to you at that point when it gets to the underwriter.
Okay, fantastic. Thank you. I'm going to take one more from the advanced questions, and then we've got lots and lots of questions coming in during the live, which I'd like to get through as well. So Craptacular8282 on YouTube asks, and I initially discarded this question, and I thought, hang on, actually, that's quite a good question. Should I be worried if I have AIPs from 2 different mortgage brokers with vastly different borrowing capacity? Maybe that's not a good, I don't know.
I would say it would raise a flag, but there's likely to be an explanation. Well, you would hope there'd be an explanation. Now, it depends upon a couple of factors. As we mentioned earlier, lenders have different affordability metrics that they're going to run. So it may be the case that, for example, if you told a broker that you want to buy at 200k and you've got a 10% deposit, they may just run a decision in principle for 180k. And give that to you if that's what you've decided your budget is. Other brokers may run a maximum decision in principle and pass you that. Now, on top of that, some lenders on their decisions in principle will say, this is what you've asked for, but this is what we can borrow up to. And some will just outrightly say, this is your maximum borrowing regardless. So it varies lender to lender, and it varies depending on what instructions you've given to those 2 different brokers. So it may be a flag, probably worthwhile just clarifying.
Okay, cool. Right, we've got lots of questions, some great ones here. Here's a really quick one for both of you. Harmony Financial Services asks, who has the best beard in financial services?
That's not Imran.
So that's Imran, who's a friend of Graham and I's.
It's not me, because I can't grow a beard, I can assure you.
Yeah, it's not Graham. So it's generally between 3 people in financial services. Myself, Dave Corbett, who's a protection specialist at Mortgages First, and Ian Hewitt, who's known as the bearded mortgage broker, who often wins those awards. So it's generally between Ian, Dave, and myself. There are normally kind of spoof awards throughout the year. So it's one of those 3.
It's never me.
Right, more serious question. Here's a very generic one, but I think, again, it's good for people who are new to this. What's the most important aspect, asks Derek Ogilvie, that a bank or broker looks at during a mortgage application? I mean, there's a long list, isn't there? But what's the most important thing they look for?
Credit.
So your
credit score is, I mean, there's no one thing is the right answer, because you've got valuation, what's the property type, income, outgoings, but the sort of bar having no income does happen. People do approaches saying, I actually don't have an income, but can I borrow? And that's fine because people don't understand how it works. But by having zero income to your name, it's going to be your credit, because that is your sort of starting. Well, that's like your fork in the road. If you've got, if you've got certain credit profiles where there's been issues in the past, then that's going to lead you on down one path straight away because you can't deal with a certain section of the market. Whereas if it's a sort of clean standard file, then you've got other options. So that would be the first thing. But I would say everything's. I would liken it in a state of clients. It's like lots of little hurdles. You've got all these little things you've got to clear. And as long as you know what's coming up and how to clear them, and more importantly, what you can do if you can't clear that one, then that is it. But you just bite-sized chunks all the way through, and you're fine. Really.
Okay, fantastic. Jonathan Bristow on YouTube asks, have you seen an increase of down valuations in the last 6 months?
I haven't actually, no. So there was a lot of down valuations when prices were rising very quickly after we go out of the pandemic. There was when we had that big increase in house prices. So there was a ton of down valuations happening then, with estate agents possibly pushing the margins a bit and people getting a little bit overzealous when they were offering. But no, in the last 6 months, I'm trying to think if I've had any. I mean, no. I mean, well, I've had a couple of down valuations where there's been a huge chunk of equity and the lender has done an automated valuation where it's just ran through a decisioning system in the background and not actually done. They've not sent a surveyor out. So it may be, but that's a like an HPI index type thing. So that wouldn't be classed as a down valuation in that respect. No.
Okay.
So I haven't.
Okay. Jimmy Davis asks, if your credit score on Equifax is fair, despite never missing a single payment and no issues listed, could this be a problem in getting a mortgage?
I think it'd be down to the reason. I mean, fair is not it's a generic term they apply to the score. So it could be there's a lack of credit on there. That could be one. There'll be a reason to why it's fair if there's no issues on it. It could be things like not being on the electoral roll. It could have accounts open at different addresses. So it might be the sort of thing that, without seeing it, can be improved just by a bit of credit file admin. That's an exciting thing to do on a Sunday afternoon, isn't it? But just making sure that you're on the electoral roll, you haven't got other accounts at different addresses, everything's up to date, everything's spurious is closed off. You haven't got lots of old credit cards that you've had and paid off that are still open with the ability to draw down large funds overnight. So no, I don't think it would be. It's not necessarily a problem because remember, lenders are going to look at all three credit reference agencies. So it might be that's fair because of their scoring system, but your one on TransUnion or Experian or something is that much stronger. So no, the thing is to not really worry so much about good, fair, very good, and all that. It's what's the data contain, and there's guides out there on how to read them, and certainly the credit scoring agencies have their own guides on how to read the reports. But if not, put it in front of someone like me or Lewis, and we can look at it and tell you pretty quickly if there's anything that's going to be problematic.
Thank you very much. Claire de la Mer says, "Yay, I made a live stream. With a 60% deposit, should I still go through a mortgage broker or straight to my bank where I have my deposit?" Thanks.
Okay, so I'm going to say a broker, but then of course I am extremely biased. So take that with a pinch of salt.
Extremely biased.
Extremely biased, yeah, of course. All I'm after is stitching people up with tons of debt and then running off interest.
Like a Victorian bad character.
So it's entirely down to you. Generally, there are additional benefits to using a broker, such as generally if you apply for a mortgage with a lender X, directly, and everything stacks up, yeah, I'm sure you're going to get a mortgage through, no problem at all. But what brokers do on top of that is, one, of course, generally we've got advance warning of rate changes, etc. So it may be the case that you go to Bank X, but we've already had an email today, yesterday, etc., saying that Bank Y is going to be reducing the rates. Now, you wouldn't see that. So we could say, okay, hold off a couple of days, we can do this, because you've got that kind of deposit, and the chances are that you're going to fit with most lenders, assuming you've got the income, all that kind of jazz. Moreover, certainly in the past few months, as various lenders have reduced their rates, generally most mortgage brokers will jump in. So let's assume you've got a mortgage again with lender X, and let's assume that mortgage lender X, when you applied, it was one rate, but now their rates have come down and they're down here. Now, if you're borrowing a significant amount of money over a significant amount of time, that reduction in rate can make a big difference, both to the total interest you pay overall, but also to your monthly cost. Now, we can switch you to that lower product because we'll get warning, of course, that those rates are reducing. The chances are that if you go direct and a lender reduces the rates, they're not going to pick the phone up and go, hello, Claire de la Mare, by the way, we've dropped our rates by 0.5%. Would you like us to switch you to this lower one? That's not going to happen, or at least I've not heard of it happening. So there are other reasons on top of that to use a broker. It's not simply about rates and all the rest of it. So it's your call in that respect.
Right, I would like to add something to this. It's from a completely impartial and objective point of view, to me, if you go to a lender to see what you can borrow, you're only going to find out what that one lender can lend you. If you go to an independent whole of market broker, you will find out what that one lender can lend you and also what all the other 100 or so lenders might lend you as well. So to me, I cannot understand why anyone, I mean, sometimes if it's easy, you're there, your bank's offering you a great deal because you're already a customer and they just, tick, 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 it's easy, boom, great, fine. But you still don't know that you've got the best deal unless you've gone out and checked the whole market.
But Charlie, it's not easy because you've still got to sit through a 2-hour interview with your bank because you've got to take advice. So you've got to go through the same process you would with a broker just to be told about their products at the end. So, 90% of people use an intermediary. I mean, 10% don't. That's fine, but 90%.
It's in my mind, just purely objectively, it's a very questionable decision to not consider the whole marketplace and just pick one and go, oh, you'll do. What will you lend me then? Oh, okay. Oh, I should have your product, should I?
so on that, so I'll give a real life example here. So recently I did an application. It was a couple of months ago now, and obviously rates have come down since then. But by switching the product after it had been offered, so it was a 5-year fixed rate that this particular customer had. That saved them over the 5-year term just in excess of £7,500 just by me switching the product. Now, admittedly, it was a large mortgage, and we can't say for sure that that's going to happen and continue to happen into the future. Of course not. But that's a big chunk of money that, if they had gone direct, that wouldn't have happened.
Right. Yeah, absolutely. Okay, fantastic. I've got one question here that's not a serious question, but it's just so good I had to put it on the screen for a second. So Max Bumfluff on X says, who is going to win the Grand National next year, and should I put my house on it because I'm mortgage free? I just thought that was a really fun question. Obviously not a serious one. Next serious question. Well, there's a couple of comments I just thought are worth showing here. So thank you, Claire Lemmer, for that question. That was good. Catherine Evans says, not a question, but we've just remortgaged and had to stay with our current provider. Life's just so expensive, and I have a child now. Credit cards maxed out, missed payments, overdrawn, etc. So I wondered if you guys are seeing, are you seeing in the remortgaging side of things a lot of this kind of situation? Are you noticing more stress in the market?
Not massively from my side.
I've seen
the loans were stress tested at higher rates. I think things are difficult. I'm not saying things are rosy, but and Lewis and I operate in different areas of the country and everything else. But there's not been, there's always going to be the odd case where situations change and it's very difficult. But I wouldn't say there's been a marked increase from our side. There's been concerns about it. There's certainly been more concern with what's going to happen with my mortgage. Rates have gone up. How much is it going to cost me? They come to us. They're very worried. Once we go through it with them and we show them the actual cost, it comes over like, well, I'd rather pay less, but we can make it work, sort of thing. So it's it's not something I'm seeing loads of, but I say Lewis might have more exposure than I.
Okay.
Broadly speaking, it's been better than I expected. To be fair, I thought there would be. I thought I would see much more of that, and touch wood for everyone's sake. So far, I haven't seen it.
Well, I had Richard Donnell from Zoopla on the channel a couple of days ago discussing the Zoopla's house price index, and he made the point that there are far, far fewer people on very high loan-to-value mortgages in this market than there were 15 years ago. It's a very, very small proportion who are on a 95% or higher loan to value mortgage, but back then there were a lot more, and therefore that's why he's expecting a lot less actual defaults and repossessions, which is very good news, very, very good news, and I hope he's right about that. Got some more cracking questions coming here. Okay, so this is the question we get a million times, all mortgages get, and I wanted to bring up the topic here. Do you recommend a 5 or 10-year fixed? And I obviously the answer to this always depends on people's personal situations and everything else, and you can't answer that generically. But I put a survey up on X asking people which is more important to them, certainty or the chance of a saving with the risk of a loss. And 80% out of about 500 people, 80% that replied said certainty is more important to them than the chance of a saving, which is, I mean, obviously why certain people take out fixed mortgages. But of course, I imagine this question must be difficult because, of course, it's impossible for you to know based on, no one knows what interest rates are going to be 5 to 10 years from now. But people's individual I think the relevant point I wanted to make here is that the answer to this question is always a personal one, and it always depends on the individual circumstances, a long list of them. There's never a generic answer to this question, is there?
No. And the 10 years, 10-year fixes are, 10 years ago I had no kids. Was I even married? Just maybe. You know what I mean? It was a very different landscape for me 10 years ago, Charlie. But things do change, and the potential for loss is quite strong, a 10-year fix, because if you have to come out of it early, you're going to pay a big chunk. So I think my approach for my life, I've always preferred, if I'm going to do slightly long term, is 5 and then 5 again, because it gives you that break. And as I say, you are right, it's about personal circumstances. It's having conversation with clients about, oh, look, how old are your children? Yeah. Okay, one's 6, so they're going to go to secondary school 5 years' time, maybe for debt. Oh, you've got someone's going to go to university in 3 years' time, maybe 3. And just what are the life events? And you're right, we're not soothsayers. We don't see what's coming down the road. But it's just, I think a lot of our job, I think the misunderstanding sometimes is that people come to us expecting answers. This is what you should do. And there's an element to say, this is what I think I would do, but it's up to you. But actually what our job involves is asking questions of people, so they can, because a lot of times they go, oh, I didn't think about that. And you go, okay, well then, and then the client will go away and think about it and come to their own conclusion, which is ultimately what it is. We're not there to sort of railroad anyone to doing something because we think it's right and that's what's going to happen. Far from it. So I say, have you thought about what if this happened? And then just through the process of sleeping on it, asking questions back, you arrive at what you are comfortable with and what is right for person A or is wrong for person B. And that's what's so wonderful about it, is that everyone's got their own very personal opinions and lives.
Thank you very much. A couple of other good questions here. Roland Pitch asks, can you switch lenders as well as products, say 3 weeks ahead of exchange?
I wouldn't. You may be able to switch products. Now, this comes with a caveat. So when we're talking about kind of, if there is a lender, if the lender you've got an offer with does have lower rates. Now, this varies lender to lender, but some, depending on how long the offer's been issued, some may rescore you, as in recredit score you. So there is an element of risk in doing that if their credit check has kind of expired. So 3 weeks ahead of exchange to switch to a lower product, potentially, yes. To make a brand new application with a new mortgage lender, I personally wouldn't, but that would be for an individual to choose. I don't know what Graham's thoughts is on that.
3 weeks is, I mean, the credit score, all things remain equal. So, your credit hasn't changed and everything else hasn't changed and all that kind of stuff. It's a tight time scale. We've done it because there are lenders that can do things very quickly, but you have to be aware of the risks. If that exchange date is set in stone, what you often find is that, there's some maneuverability, but you've got to be very careful. It's got to be a hell of a saving, isn't it, to do? Because sometimes the conversation is, well, yes, there is potential you could do it. You're going to save yourself 30 quid a month. That's your saving for your risk, and we get very bogged down in what is the interest rate, but what's it doing to your monthlies, and is it an acceptable risk for you to do that? If it's a property you're not bothered on, if it's one of 5 you've got lined up for an investment, then you might be more inclined to do it. 3 weeks would be a conversation. I think
that's actually answered a couple of other people who had the same question there. Just quickly, so Ivan Georgiev, thank you very much, Ivan, for that. Really appreciate that. Thanks again for your template. I was able to secure an offer for 30k below asking price for a house in the southeast coast. And then on the back of that, Laia Alvaro Sanchez says, where can I find your offer template? So it's on my website, mhwc.co.uk. But if you just Google or search for Charlie first-time buyer email offer template, it will come up. And it's just free to use and copy and paste it. There's a Google Doc version you can copy your own version out of. And I'm getting every single day, I'm getting people telling me that they are getting results using that template. And even agents coming back and saying, that is the best offer we've ever seen in 15 years in terms of how complete and comprehensive it was and easy to recommend. So please do check out my offer email template because it is a cracker. It's working. Next question. Do either of you guys, I don't know if you guys have an opinion on this, but Andy XTR on YouTube says, what's the crack with 99% mortgages? I mean, obviously it's just been mooted by the government, but I just wonder what they're asking, what your opinion on those is.
Not overly keen.
I think it's a useful mechanism to bribe voters, specifically younger people that are struggling to buy a home. Now, I don't necessarily. I mean, I wouldn't want people to have a 1% deposit. I don't think there's quite enough skin in the game, if I'm honest. Although that said, we already have 100% mortgages, and we have had for some time, even prior to the one that was launched not that long back, where you can put up, potentially a parent's house as collateral, etc., and borrow 100% loan to value. So I think we could do more around potentially lower deposit limits, because that can be a big stumbling block for many people. But I'm not a fan of it coming directly from a political party that may be on the roads, because I'm not sure that the vested interest tallies with the best interests of people. Maybe I'm wrong. I don't know.
Cool, thank you. Clueless Crypto says, I've been self-employed for a number of years, but would now like to take a sabbatical for 2 to 3 months. How would this affect my mortgageability?
That's tricky. So there's two things of that, right? The first is that if you're self-employed, a lender looks at your previous year's earnings, right? 2-3 years earnings. However, they will ask you, do you expect there to be any material change in your circumstances or income for this application? So if you can earn all your money that you earned in the previous years in 9 months, well, then there's no problem, is there? If you're going to be short by, 2/3, whatever it's going to be of your income for the next year, then you're on shaky ground from that perspective with disclosing it to the lender. But if it's I might do this, I might not. I was meant to win Euro Millions last night and it didn't happen. So, if it's something you're definitely doing, then it has a material change. If it's an idea, you might, but you might not. Then it's not actually something that can be factored in. But there's two things. From an income perspective, it's always looking backwards for self-employed individuals. But there are questions explicitly asked of you that you will need to be very careful as to how you answer, because you cannot say one thing if the other is true.
Okay. Guys, a few of you are asking some good questions, but they're not related to mortgages. So I'm going to, at the end, when Lewis and Graham have had enough and want to go, I'll stay behind after they've gone and answer a few of those questions that are coming in, because there's some good ones. But here is another important one from Demora Mortgages. If Lewis was to have a theme tune, what would it be?
So I know the answer to this question. So often I'm cutting about in a woolly hat, like a little beanie. And because of the beard, it seems to me that I'm now classed as the trawlerman. Actually, a new trading style, trawlerman mortgages. So I don't know if anyone
controls the market.
Yeah. So if anyone goes on TikTok regularly, they'll have seen the clips where there's, for example, workers out in the North Sea, or they might be on shipping containers, and there's that kind of that theme, like yo ho, all that kind of stuff. So that's the theme tune. And I'm not going to start singing, but if you follow the Broker Collective on TikTok, it
will be there. Yeah.
Okay, that's brilliant. Okay, it's good to see you've got your industry colleagues supporting you on this live stream. Love it. Right, back to a more serious question. Unlimited Pizza asks quite a technical question, I think. Will using a pension salary exchange with my employer adversely affect my borrowing power when we apply for a mortgage when we move?
Some will, some won't.
Yeah, some will, some won't. So, for example, some lenders will take all or most of any kind of payslip deductions off your affordability. Others will add it back in. And so the rationale is, for example, some lenders would say, we don't want to exclude those because we want to make sure that you keep paying into a pension, and therefore we're happy, but we're going to reduce the amount you're borrowing. Other lenders take the view of, well, we'll lend you this and we'll discount that, the pension contribution, simply because we think that if it comes between a choice of paying your mortgage and paying into your pension, the chances are you'll stop paying your pension and you'll increase your mortgage payments. So it varies.
Fantastic, thank you. Now, this is it's Roland Pitch again. It's a really good question, because I get asked this quite a lot, and I don't actually know what the answer is. What happens if, having had a mortgage offer on a property that you've had accepted, if you renegotiate the price after having had the mortgage offer? Now, that can be obviously a renegotiation can happen for a list of different reasons, but if the offers come out, I mean, I've heard some people say that there is a risk that you then lose your mortgage offer, even if the property is renegotiated to a lower price.
No, you've got to. So what happens if you renegotiate? You've got to have your offer amended, because the offer has to reflect the purchase price. The key thing is what happens with the valuation, because a valuation before you've got your offer has already been carried out. And assuming, say you're buying at £200,000, the valuation comes back, yeah, we think it's worth 200. It's 200 on the offer. You then go back and drop your, you get it for 195. So it's not as simple as go back and saying, right, I need the offer to reflect 195, because the lender's going to use the lower of the purchase price or the valuation. So whilst you've had a valuation at 200, they're then going to use 195. So that's going to have a knock-on effect to things like loan to value. So if you're at 95%, you've got to make sure you always have the right banding on that side of things. So it's not a problem at all having a renegotiation, but it has to match up across the board. I think there are certain occasions where very small amounts, where solicitors can what's the term I'm looking for here, Lewis? They can get over it. They don't need a new offer. They can put something in to factor it in some other way, which is not. You'd have to ask Simon about that. But yeah, for the most part, you renegotiate. The first call after renegotiation should be to your broker, so we can then update the lender and just make sure that all you're not going into a different product loan to value or something like that. But it shouldn't end up in an offer being rescinded in most cases.
I've got a good question here from a new name I don't recognize, which I think, Lewis, also leads into what you wanted to talk about. So Anticure MR asks, do you do all the checks, like make sure that the applicant data is already correct between different credit agencies used by the bank? And Lewis, you wanted to talk about paperwork, didn't you? Applicants getting their paperwork in order properly. And I don't know if this overlaps with this question or not.
So with regards to applicant data being correct, it depends on the discrepancy. So, for example, it could be that a credit reference agency has different balances across maybe a credit card or an existing mortgage or a loan. So it could be that there's a different balance because depending on who that provider is and which credit reference agencies they report to and when they update them. So, a small discrepancy like that is not going to make a huge deal of difference, ordinarily, unless it's really on the margins of affordability. If there's big discrepancies where, for example, you're showing as where it may be a status 6, which is classed as 6 months in arrears, where another credit reference agency may show as a default, that would be potentially a big problem. So it varies depending on what the data says and how much of an impact that might have. Generally, we're going to, cast our eye over a credit report and make sure that everything looks okay. The big things are often not the individual bits of, excluding adverse credit, so defaults, categorical judgments, etc., those kind of things. Excluding those, what the big things are address history matches, electoral roll matches, that type of thing. So that information is very important because lenders will use that to perform often an electronic ID check. So making sure that address histories are up to date, etc., is very important. Yes.
Fantastic. Okay, right. Just a couple more questions, I think, and then we're going to let you guys go if you need to go. But here is an interesting one. Derek Ogilvie again asks, how long does a bankruptcy really affect a mortgage application?
Varies from lender to lender. Some lenders won't accept applications from anyone that's ever been declared bankrupt. Some will accept it in theory as soon as you've been discharged.
Right. Okay.
It's the resultant credit file that often is the stumbling block. But the more clear water there is between you and the bankruptcy, the better your chances are. But some lenders have a defined question that says, "Have you ever been?" And then it's a no from them. So it's a tricky one. But the more time between the event and the bankruptcy and the time you need to apply is the best case.
Okay. AJ on YouTube asks, how do I deal with the timing of the 3-month AIP? As mine already ran out, and I'll be honest, I felt like it was a waste because the property I went after fell through.
That's unfortunately just the nature of the beast. There's nothing that can be done about that. That's just how this works, unfortunately. Often they're not a waste because it's allowed you to, I'm guessing if it fell through, make an offer. So it got you that far. It is what it is. It's not going to harm you. For most mortgage lenders perform a soft check. So whilst you will see that they've credit scored you, another lender wouldn't. So it's not going to materially or have a detrimental impact. But that's just the nature of the beast, unfortunately.
Okay. All right. Jack M. Davis asks, how much does the state of the property affect a mortgage application? We've recently put in an offer on a Victorian terrace that is on the market after 60 years.
Well, it's going to be reflected in the valuation. So as long as it's habitable and mortgageable, so kitchen, running water, all that kind of stuff, it might need 60 years. It might need a complete rewire. Who knows? They might have had it done 5 years ago. But all those things are going to factor into its valuation. So as long as you're buying it at the price that is the market dictates it is at that point, and the surveyor agrees with that. If you're trying to buy it on the basis that it's a done property, so you know what you're going to add to it is going to be, well then no, it's going to come unstuck. So the basics are running water, kitchen, bathroom, those sorts of things, no holes in the roof, no damp running up the walls. But outside of that, fixtures, fittings, that will just be reflected in the purchase price. So it's not as long as you're paying what it's worth and it's habitable, you should be okay.
Great. Vikesh Mystery asks, in the new climate, is it better to have a much smaller mortgage and renovate than stretch ourselves for a, quote, dream home?
I don't think that's a stupid question at all.
No.
I think it comes down to your personal preference, ultimately. Generally, the smaller the mortgage, the better, certainly, because, of course, you're paying back smaller monthly payments, less interest overall. So that's always going to be a positive. But then it comes down to if you want to live in a building site. It's not particularly enjoyable. It often costs more than you think and takes longer than you'd expect. But ultimately, it gives you the chance to make your own mark on a property. So I would say that would have to come down to personal preference.
It depends how much it's going to cost to renovate. I mean, if you can do it yourself and you're good at it and you're handy, then probably that's the better option. But if you're someone like me, I mean, it would cost me a small fortune because I'm so useless at everything that it would. I'd end up outstripping any gains. I'd probably devalue the house if I did it myself. So yeah, Lewis is right. It's very much about individual circumstances on that one, I think.
All right, we've got one last question. I'm very curious to see your answer to this. From Joe Montoya, who's watching on X, who says, do you think we will see more buy-to-let mortgage products in the near future?
I don't know about more mortgage products. I don't think there's necessarily a lack of them anyway, if I'm honest. Most lenders seem to have a pretty good offering currently, and the interest rates that they were charging have come down markedly, albeit they've been offset by some potential higher booking fees in some circumstances. So possibly it does. There was some research out. It was yesterday or the day before by a mortgage lender. They said apparently, according to them, 50% of portfolio landlords were looking to expand their portfolio in 2024. So if there's more demand from landlords, then the likelihood is that lenders will probably innovate and offer more. Yes.
All right, guys. Well, listen, I'm going to wrap it up here, myself included, in fact. And just to remind everyone that if you don't have a mortgage broker, or don't have one you're happy with, or don't have one that you trust, I handpicked these guys up there above me because basically of the sense of integrity I've had from the beginning that's just been reinforced and compounded now that I've been working with them for a while. So if you can't find an independent whole of market mortgage broker that you trust, I recommend you talking to these guys. Down there is the URL. It's in the link below as well, mhwc.co.uk/mortgage, and you'll be able to have a chat with them. Otherwise, Lewis, Graham, thank you very much again. Hopefully we can do a similar thing in about a month from now, a monthly mortgage market. And thank you everyone for watching. Considering you're all supposed to be at work, it's quite a lot of you here. But thanks a lot, and we'll see you on the next video. Thanks, guys. Bye.